Hello YouTube, welcome to the Common Investor channel. Today I'll be talking to you about my Trading 212 account. Obviously I set this up the beginning of the start year of the tax year, April 2020. So which is why I've not been putting money into my Freetrade account. Basically I've just been recycling the same cash over and over again. Because obviously you can put, money into another ISA when you've opened or stock ISA when you open a new one for the tax year. So this is going to be a pretty it's going to be a bit of a rant actually. What I'll do, I don't know how to do it, but if I can put some timestamps in the actual description um, below, then I'll put them. If I can figure out how to do it, I'll put it in there, and then you can kind of skip to they're probably going to be like 2 or 3 sections, one for the rants, second for the pies, which I'm guessing is the reason why you're going to be watching this video anyways. So at the moment my portfolio is valued at £4,822. I am up 77 pounds essentially, or £78, and which is like 1.64%. So don't get it twisted. It shows that I'm up, but overall on the portfolio, I'm actually down. I've lost. I'm down 190 pounds, and this is because of Wirecard. So yeah, I was involved. I got caught up in the whole Wirecard fraud thing. For those people who don't know, Wirecard is a company based in Germany, and they basically do payment processing. And they were getting audited, and they lost 1.1. Well, I think it was about 1 billion or something like that. 1 point something billion euros or pounds or whatever kind of went missing, and they've not still been able to find it even up till now. So basically they were accused of fraud, and once and they filed for insolvency as well. So yeah, the company basically went bankrupt, and you know yeah, it's just poor management. So when that news broke out, initially I think it broke out. There was a bit of funny business that's kind of happened around January. Then there was supposed to make an announcement or earnings announcement or something. They postponed it because they couldn't find the money or whatever, or something didn't look right with the books. So they postponed about 2 3 times, and eventually I think Wirecard just kind of admitted that yeah, they basically something seems to be wrong, and essentially the stock just kind of crumbled since then. This was like a stock that was about 100 and something euros if I remember. Literally went down to about 60 or 50 something euros. Then it dropped a bit further down. So I bought about 60-50, and then went down again, moved to like 12 or something, and I bought again. And I went down to moved to 20 euros, I bought again. Then I think then finally came out, that is actually, it looks like Wirecard have actually been involved in some fraudulent activity. And then they then basically just kept on crashing from there on. Crashed like one, and then eventually, I don't know, maybe it's this retail investors or whatever. From one, it kind of went back up to 9 euros, and I basically have a philosophy that if I'm not interested, if basically the reason I bought a stock has changed, yeah, if that's changed, then there's a good chance I'm basically gonna sell that stock, regardless of if it's in a profit or not. Obviously, it depends on the kind of loss that I'm gonna be taking, but I think it's something I did recently for BP, where I basically sold at a loss, but it was something I could actually pocket. So ended up I didn't sell it at 9 euros. I ended up selling it at 6 euros, and yeah, basically lost about 500 quid. So I've been doing like little short trades here and there, in free in what's it called, in Trading 212, and I've been able to kind of, I guess I've made about £300 in profits from the trades. So which is why the account is basically showing that I'm just approximately minus the 22 to minus £200 down. But I have received some dividends previously. I received one today from Medical Property Trust of £2.18, which is quite good actually. So yeah. So yeah, today I'm just gonna basically talk you through my. This is literally like my strategy now, and I don't think I'm gonna be changing it. I might dibble and dabble in the things here and there, but my main focus is definitely dividend growth investing. I feel like it's a long thing, and it's something that's obviously won't happen within the I don't know 5 year or 10 year, or 5 year frame. It's probably more of a 10 year frame you're looking at. So with dividend growth investing, definitely the earlier you start, the better it is for you. It's one of those ones that if you have kids or basically the earlier you start, the better it is for you. So initially, I didn't really understand what dividend growth investing was. I just thought dividend growth investing was basically a stock that pays dividends, but at the same time, it appreciates in value. Um, it appreciates in the share price appreciates in value quite a lot, but that could be further away from the truth. That couldn't be further away from the truth. So dividend growth stock is basically a stock where the dividends um, is the dividend is basically increasing um, year by year by a certain percentage, and a good company that's world renowned for doing this is Johnson and Johnson. So that'll be a typical example of a dividend growth stock, and you want to basically be doing it with nice, decent, solid companies, reliable companies. You don't want to be doing it with companies like Micro Focus, because I've got Micro Focus in my one of my other accounts, and that's basically that's been a bad one. That one. I think if you think £500 is a big loss, you should see Micro Focus. I think Micro Focus have probably lost about, I don't know, probably close to 2 grand. I think I've not lost it, but unrealized losses basically is up to 2 grand. So I'm just basically gonna hold it for as long as I can, and you know the company is going through some rough patches. I don't think it's going to be like a company that goes bankrupt or anything. It's just a lot of negativity behind the company. So hopefully, in the next 2 or 3 years, it can recover. Obviously, the pandemic hasn't helped at all. So, but it's just one that's never recovered from pandemic. It's just been going down and down and down and down. Um, yeah. So essentially, just gonna run through this portfolio. Well, not run through it essentially, but maybe run through Dropbox, which is it's different from the um, dividend growth investing style, but I think it's just one of those two. One of those. These are the two styles I'm going to use: dividend growth investing mainly, and then if I'm going to do individual stock purchases, it's going to be more of a high risk, high reward type strategy, where I put down a lot of money into a stock after doing a lot of research on it, right? And the reason I feel comfortable doing this now is because I feel like after doing this for about 4 years, that I can understand what makes a good stock, right? And keep in mind as well, I will only be doing this for companies I consider as being good value, right? I won't be doing this for growth stocks. For me, would be more of a short trade if I get into a growth stock. Um, but growth stock that has like a stupid PE. That's what I mean. Because there's some growth stocks that you just can't stop them, like Shopify. Shopify is just ridiculous, and you know, it's it's really overvalued. But those are growth stocks for you. I think if I'm going to invest in a growth stock, potentially I'll just do it through an ETF or fund or something else, but not really directly. And I'll show you how I'm invested in growth stocks within this within my pies essentially. So yeah, back to Dropbox. Dropbox is basically a cloud storage company. But I think over the years it's been trying to reinvent itself into being a more functional cloud storage unit, where it's basically trying to incorporate more functionality within its cloud storage platform. And I think to me, it's definitely come across as that, because I used to have Dropbox about 7 years ago, and I never used it. I've used it a little bit actually, but over the past 7 years, I've barely used Dropbox. And I logged into, while I was looking at the stock, I said, "Oh, let me just have a look at what Dropbox has to offer now." And I went to I went to my account in Dropbox, and logged in and everything like that. And to my surprise, it's definitely more functional. You can kind of see they've added a few more features that kind of sets it apart from other cloud storage, units where it's just a pump and dump type thing, where you just dump data and that's it, and you only go there to retrieve the data, then use it. So they have some cross functionality features that allows you to use um, documents or files that would only run on probably on Microsoft Office or Google Docs or something like that. They basically, you have that cross functionality ability within Dropbox. You also have something called HelloSign, which is the main reason why I looked into made me interested in Dropbox actually, because obviously everyone's heard about DocuSign, and DocuSign basically skyrocketed during this pandemic period. Literally, I think, where's DocuSign? So yep, there you go. I mean, that's another problem with trading TOT sometimes. Just the charts aren't really point. But anyway, you can see what DocuSign has kind of done. It's done almost well, yeah, 59% in the past year. So let's say in the past 3 months, yeah. So it's probably done more than that then. So I think it was a bit cheaper than that before. So yeah, this basically has a HelloSign incorporated into it, and it's a company that's been acquired by Dropbox over the in 2019, late 2019. So Dropbox, basically the revenues have been going up slightly and earnings have been going up slightly, but if you compare it to other growth stocks, it's nothing. It's not compared to this. The growth rate is it's basically shite. So, however, with them acquiring HelloSign and the current pandemic situation, they should be able to get some decent revenue from the acquisition, and also getting more people onto their platform as well. So that's kind of what I'm banking on. And at the same time, it's one of those stocks that hasn't, recovered with other tech stocks essentially. It's still pretty much down, to be honest with you. So and if it's a little bit of technical analysis here, you see that point there and that point there seems to be it's formed a support essentially, and it doesn't go down below that point, and it seems to have formed a resistance around this point here. So I feel like there's a breakout coming. It's just a matter of earnings. It's just a matter of earnings essentially. The earnings is good, then I believe it's gonna go up probably to about 25 or maybe 30 max. What's this here? Probably 25, 30 or something like that, depending on how well people take to it. But that's kind of, if I'm going to invest in stocks like this, that's kind of the way I'm going to be investing now. Big amounts, high risk, high reward type thing. But obviously I have to get my shit together and make sure that, it's basically going okay. It's going to work in my favor. So with that said, let's just move on straight to the pies. This pie, the way I've created the pie is basically it's been created in such a way that I'm focused on dividend growth investing, right? Which is essentially what that F.I.R.E portfolio is. You got this one here, which is anything and everything, which technically it is, I guess, because you have the Vanguard FTSE All World, which is basically I think 3,000 stocks, over 3,000 stocks, is captured by this ETF. And I just thought, what, if the channel after all is common investor, and I was thinking, if I was a common man, just regular person, want to start investing, what advice would I give to myself now? And the advice is stay away from stock picking. Literally, do not bother about stock picking. Okay, go look for some cheap some ETFs or some funds that basically the fees are really low, right? And obviously, you want to look into what those funds and ETFs actually comprise of, and make sure they're good companies. Because some ETFs and funds, they sound nice and everything like that, but they're just absolutely shit companies in there. If you what I think it's called the Great Shorts, that was basically captured within that movie, where a lot of people were investing in like funds and what on I think trusts and all that kind of stuff, but the stocks that were in there were basically shite. So yeah, always obviously be careful about what you invest in. I mean, Vanguard in general tends to be really good. I don't think they don't mess about. They don't mess you about by leading you astray. So yeah, Vanguard is a nice, reliable provider of ETFs and funds to look at. So Vanguard FTSE All World. I'm going to be investing about £100 in this every month. The according to the auto invest feature, it basically says that this should give me about a 10% return every year, and I'm happy with that, to be honest with you. So just £100 every month, to get my little bit of money here and there, and yeah, Bob's your uncle. So next one is F.I.R.E portfolio. The F.I.R.E portfolio essentially is made up of dividend growth stocks, or mostly dividend growth stocks. I would like it to be all UK stocks, but just want a little bit of diversity here and there. And there are actually some pretty good stocks in the EU with good dividends and dividend growth rates as well, which you see a bit later. So yeah, I mean, I've got Admiral, like Polymetal. Um, those yeah, like these are pretty good stocks. For dividend, Polymetal is good stuff for dividend growth. Home Serve, good one. Rio Tinto, it's an ace in the hole. Rio Tinto. I didn't know how good the dividend stock Rio Tinto was until I researched it this weekend. Actually, Group, it's a good dividend stock. It's not really. I wouldn't buy it for any other reason, to be honest with you. But as a dividend stock, dividend growth stock, it's pretty good. Um, Games Workshop, perfect dividend stock, dividend growth stock rather, and they do pay quite decent dividends as well. Intertech, I think, is the highest paying dividend stock I have right now. No, UK dividend stock, and they do offer good dividend growth rates as well on a yearly basis. Safe Store is probably the lowest dividend paying stock I have now, but it's they do offer consistent growth over the years. So same as Reflex. So Unilever, Diageo, and GlaxoSmithKline. So they are good dividend stocks. I wouldn't. They probably, yeah. Unilever is okay. I think they grow about 6%, 7% every year from a dividend point of view. But Diageo and GlaxoSmith, I'll say they're just good dividend stocks. Probably same as Admiral as well. Might be wrong about Admiral. Not sure. They are good dividend stocks, but they're not good dividend growth stocks, right? Because they don't really grow the dividends that much or as frequently as I like them to, anyways. So, which is why they're a bit further down. I think Admiral, they probably do grow to. I think they probably do grow every year, and I don't know why everyone's going on about what's it called, Legal in General and Aviva, bruv. After looking at Admiral Group, from an insurance point of view, Admiral's looking sweet, so you might as well have a look at Admiral, guys. And allow this Legal in General Aviva to go to just go bury itself somewhere, man. So next one is I expose myself to the American stocks, which is through ETF, the S&P 500 high dividend low ETF. It's pretty good. That yields about 5%. So yeah, I can't remember what the payout ratio is. Or what the dividend rate is, but that yields about 5%, which is pretty good. So I'm happy with that. I don't need that for anything. I don't need to invest in any other American companies or American stocks. Just that's fine by me. You got Pennant Group, good dividends. low dividend growth rate. Halma is, I think Halma is a low dividend rate or low dividend payout. But they do have a good consistent dividend increase every year, maybe about 7 or 8% every year. So you can tell that they're pacing themselves, and they have a very good dividend cover as well. As well above 1, I believe. So obviously they have enough money to basically, keep on reinvesting and just, keep on issuing dividends on a yearly basis. And if they want to, really, they can move that from like 10% to 20% dividend increase. So it's one that obviously I've just started loading on, and if any of these kind of start acting up, then Helmer will probably take their place. Johnson Marty, basically, good high dividend payer, low dividend growth rate, at least right now, anyways. The rest basically are either stocks that are international, or they haven't paid they stopped paying their dividend for the year, but they've had good dividend growth rates, or they have a potential to have good dividend growth rates. So you got Greg's good dividend growth rates, good dividend payer as well, but they basically aren't paying this year. So just loading up little by little until when they're ready to pay. Same for Red Roll. Schneider Electric, really good dividend payer, although they only pay dividends once a year, so I basically just put it as 1%, so I've got a lot of time to accumulate before the dividend payment comes, or maybe just before the ex-dividend day. I just chuck in a lot of money, basically. One of those, I'm not too sure. B&M is a company, I believe, I just like the company, essentially. It's up about 40% in my Freetrade account, and I feel like it's a good company, and in the future it has potential to be a high dividend payer, and also consistently increase your dividend payments as well, or dividend growth rates. SAP, basically good dividend payer and good dividend growth rate as well. So I think probably a shout out will be to IG Group. So IG Group might be one I look at actually after this video, just to I think they do pay a pretty good dividend, and the growth rate is pretty good as well, dividend growth rate. So it might be one I add to the portfolio, and just see how it goes. But yeah, so that's it for the dividend growth portfolio, which is the FIRE portfolio essentially. So obviously I'm not going to be taking any money out of this. All the dividends are going to be reinvested. I'm going to be doing this for a 20-year period, and according to Trading 212, I should get back a return of 22% annually. And also, I should, in 20 years, by investing about 300 something pounds, make like over £1 million essentially. So we'll see if that's the case. I highly doubt it, but if I make at least 500k, half of that, real estate targets, I think that's not too bad either. Growth investing, essentially going to be putting about £125 into this every month. And as I said, I don't really have any individual US stocks or anything like that. Struggled a bit to find, UK growth stocks. I mean, there's Boohoo and some other companies, but really, it's not the same as American stocks. I just kind of said, S&P 500 Information Systems, Global Clean Energy, the Scott Morgan Investment Trust, and you got the FTSE emerging markets as well. So this will be my growth, kind of thing. And funny enough, my FIRE basically has a higher return than my growth investments, possibly because it's basically ETFs, it's not individual stocks. there were some stocks that I put in here initially, like Cloudflare, Fastly, all those bits, right? I put them in there, and yeah, like literally, it was telling me like a 50% return on a yearly basis, which is quite nice. But I think for dollar cost averaging, I don't think it really makes sense, to be honest with you, because those stocks move up and down so much that I just feel like the benefits of dollar cost or pound cost averaging will basically be lost. So yeah, dollar cost averaging is just, or pound cost averaging to me works best when you have a steady increase in stock price, or maybe steady when a steady decrease then increase in stock price. But what's something that's consistently increasing is the dividend growth, or is the dividend pay as dividend that gets paid, and that's where you benefit, and that's where you get that compounding effect, which is gonna make your money basically double over time. So that's what you want, basically. Um, so yeah, I think that's the end of the video for me. It's been a pleasure, just talking to you about this and kind of just share my strategy. Um, if you want to go stock picking, please, do your thing. I'm not here to do. I'm not your daddy or mommy or auntie or uncle. Just the humble guy that's sharing his journey in investing and just sharing what he learns. And if you decide to use that for your benefit, then so be it. So yeah, thanks for your time again. It's been a pleasure, and what I'll be doing actually is I'll be doing some updates to show you why I've selected these stocks as my dividend growth stocks. So I'll be doing some stock analysis. I've not really done that recently. The one stock I wish, something about the auto invest feature as well. Not all the stocks available in Trading 212 are actually available through the auto invest feature. I think it's probably only those ones that they've classified as fractional shares that you can find in the auto invest feature, which would make sense, obviously. But hopefully Trading 212 can improve that, and I would have really loved EMIS group to be here. I've got that in my Freetrade portfolio, but they basically increase dividends 10% on a yearly basis, and they also have a good dividend cover. These are both one anyways. So yeah, that's it for me, guys. Stay blessed, and